Hey everyone, and welcome back to another video for today. So as you can see here on the screen, a dot-com bubble on Google Trends has gone up over the past 5 years worldwide, which means the search term dot-com bubble more recently has picked up quite a lot, right? If you look at the last 12 months, you can see that more recently it has gone up, especially in August. And you've probably seen it, right? You've probably seen it on YouTube, you've probably seen it on TV and maybe some other websites as well, and especially the AI bubble, right? I put here since January 2024 all the way through now. We can see it going up a little bit and then suddenly it spikes back in August. This was when Sam Altman did say that there are some bubbles in this AI market. And that's why we've seen this peak right here, and since then it has been coming down. But the talk of the town is, of course, as always, what are we today? Is it 1996? Is it 97, 98, 99? What is it, right? Where are we in this bubble or in this cycle? Because it truly is, like Tom Lee says, it truly is the most hated rally, right? It cannot be that we are going up because earnings have gone up, because companies are actually making quite a lot of money today. It can't be for that reason. It has to be because we are in a bubble. Now, while I agree that some pockets of the market are bubbly, right? You know me, I think quantum is in a huge bubble. I think some nuclear stocks are also in a bubble. And yes, even some AI stocks are also in a bubble. Because yes, you should not be worth billions and billions of dollars when you don't generate any revenue. Even if the market thinks you will be generating a hell of a lot more 2, 3, 4 years from now, you are paying an insane premium for a lot of these names. So I agree. But to say that the market is in a bubble and it's like dot-com era, I don't think that's quite fair. Now, you've probably also heard about Paul Tudor Jones. He talked a little bit about that, but he did say, look, it might be 1999 right now. But he then also said, look, it took a while, right? The stock market doubled until 2000 when it popped. Now, what's interesting here as well is that 5 years ago, January 2020, this was a title and this was an interview also on CNBC, why Paul Tudor Jones says the markets remind him a lot of early 1999. Yesterday, we've got this. Investor Paul Tudor Jones says the stock market today feels exactly like 1999. So, yeah. But that said, those are quite aggressive titles because he does have some solid reasons behind all of it. Of course, here in 2020, he did also warn already from a potential coronavirus disaster. So we'll give him that. But there are some good explanations, so I'm going to play some of the clips here as well. We're going to react over that. And then for those that did miss the Sunday portfolio update video, I do have, of course, some macro market data to show you that would back up a lot of the, well, non-dot-com bubble camp. So more on that in this video. We're also going to talk a little bit about particular stocks throughout the video. So if you enjoyed all of it, hit the buttons. Would really appreciate it. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so let's have a listen to what he said yesterday.
Exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place. And certainly from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the NASDAQ doubled between the first week of October 99 and March of 2000. So if it looks like a duck and quacks like a duck, it's probably not chicken, right?
Well, maybe the chicken identifies like a duck. I don't know. Who knows these days, right? But anyways, important to know that one, he sees himself as a trader in this position right now, okay? He sees himself as a trader. Second of all, as you've just heard him, from October 99 up until March 2000, NASDAQ did double. So you might say that before we reach a top, we might see suddenly a huge increase in the stock market. Now you might say, yeah, but we've already seen that huge increase this year and last year, and and 2 years ago. Well, to counter that argument, we can go and look at the S&P 500. Let's go all the way back to 2020, right? So in 2020, of course, the stock market crashed quite heavily, quite fast because of the coronavirus. So it went down 36% in a matter of a couple of weeks. Now, since then, since the bottom 2020, all the way to the top of what I would call a much better comparison to the dot-com bubble, 2022, right? Because if we want to compare what's happening right now or what has been happening right now over the past couple of years to the dot-com bubble, I do think that what has happened here, right? It went up 108%, the S&P 500, since the bottom 2020 all the way to the top January 2022. I do think that this period right here resembled the dot-com bubble way more than the period that we're in right now. All of these SPACs, all of the companies that were trading, and that was the normal thing, right? All the companies that were trading at 50, 60, 100 times sales, that is, not PE, sales, all of that was normal. NFTs, right? Pictures of stones being sold for hundreds of thousands of dollars, if not $1 million or so. That, in my opinion, was more of a dot-com bubble. Also, rates, interest rates were going up in that period. Right now, we are in a period where interest rates are coming down and are expected to continue to go down, which again is why I do think that back then, 2022, that resembled, to me, the dot-com bubble a bit more. And in 2022, what has happened? Well, in 2022, as you can see, from the top all the way to the bottom, market, well, in this case, the S&P, crashed 27.5%. The first 7 months of 2022 was the worst performing start of the year since 1970, for those that don't know, okay? I'm not making it up, it's the data. Now, since the bottom of 2022, all the way to now, so around 3 years, S&P went up 91.4%. And of course, throughout the last couple of years, we've had little dips, little corrections here and there. 10%, 10%, and then of course, we've had the April lows, right, which the market topped here. In February, we went all the way down 21.5% in a matter of a month or so. So yes, S&P, since the bottom of 2022, which was a big correction year across the board, we've had huge companies down 50, 60, 70%. Since then, S&P went up 91%, and over that period of time, we did have some little corrections. Okay? Makes sense. Now let's continue here.
But you think it's 99, and we were talking to Mike Novogratz earlier today. It's not 98. I mean, everyone's it's either 98, 99, but it's not 96, I guess is the point.
Right.
And that's a problem, potentially.
Right.
Or it's maybe an opportunity, but you have to get on and off the train pretty quick.
Well, if you just think about bull markets, right, the greatest price appreciation is always the 12 months preceding the top. So that's the nature of a bull market. It kind of doubles whatever the annual average is before then. So if you don't play it,
right,
you're missing out on the juice. If you do play it, you have to have really happy feet, because there will be a really, really bad end to it. And my guess is that I think all the ingredients are in place for some kind of a blow-off. Will it happen? Again, history rhymes a lot, so I would think some version of it is going to happen again.
So here, again, I don't fully disagree with him. I do think that, yes, sometime in the future, we will have a small correction, as we've always had. Do I think we will have a huge, huge crash, like the great financial crisis, like the 2020, like the dot-com bubble? I don't think so. Unless something really drastically changes and the oral financial industry collapses and whatnot, up until then, no, I think corrections happen all the time. So yeah, it's like saying, oh, today is a sunny day. Next week it might rain. Next month it might also rain, but I guess who knows? Okay, a broken clock is right twice a day. Now this is not disrespecting him, right? Because again, I do agree with some points that he's making, and also he admitted he's more of a trader rather than an investor. He's more focused on some macro trends as well. So it's a bit different. It's a bit different the way he's looking at opportunities to the way I'm looking, for example, and maybe you're looking at those opportunities as well. Now, if we go back to the interview with the same title, but 5 years ago, this is what he said.
about where we are in the economy. I want to show you what Ray Dalio said in just a moment. We also saw what the president had to say about the economy. But before we get to Ray's comment, I wanted to get your assessment of where we are.
Well, we're just, again, in the craziest monetary fiscal mix in history. It's so explosive. It defies imagination, and I don't think anything's changed. It reminds me a lot of early 99. So early 99, we had 1.6% PCE, 2.3% CPI. We have the exact same metrics today. The difference is Fed funds were 4.75%. Today, they're 1.62. Back then, we had a budget surplus, and we got a 5% budget deficit. You can't make it up. We had an impeachment. We just had 3 rate cuts because we had this external crisis. So crazy time.
So you want to be on the train, and then you need to get off of it pretty quick if it's 99.
Well, not really. The train's got a long, long way to go if you think about it, what happened in the ensuing 12 to 14 months. I would say we've got a curveball with this coronavirus. I think that's...
So you can see that even 5 years ago, the message was also a bit of the same. It reminded him of the early 1999s, but we still have some ways to go. He's purely talking about positioning. Okay, you position your portfolio in a way that, okay, you can experience the upside, but you want to limit yourself on the downside whenever the downside will come. Of course, unfortunately, 3 months after this interview aired, we've had a huge crash in the market because of the lockdowns, etc., etc. Now, I'm not going to play the clip for the other coronavirus comments because I don't know what YouTube's policies are these days because I don't want to get demonetized. Now, going back to the market data that I wanted to show you and that I've showed you in this Sunday episode. If you look here at the NASDAQ 100, what happened after it went up for 6 months in a row? We don't have that much data to work with, actually only 5 times before. Now it's the 6th time. But as you can see, the odds are in our favor. Okay, 1 week later, 60% of the time, NASDAQ was positive, and on average, we were up 0.37%. 2 weeks later, and then, by the way, the 1 week later is this week. 2 weeks later is next week, because this was released last week, just so you know. 80% of the time, we were in the green, and on average, we went up 3.76%. Of course, here as well, you can see some specific dates. 1995, 2009, we were up the most. Now, 2003, we're still down around 2% or so. If my scenario is true, then we might be in 2003 right now. Because if I think that the dot-com bubble, the 2000 is like 2022, 3 years later, we're 2023, and so the music can continue for a long period of time. But then if we look at 3 weeks later, a month, 2 months, 3 months, 6 months, a year later, we were always green. Okay, we're always green, other than that 6 months later, 80% of the time we were green, but on average we went up 7.7%. So again, the odds here are in our favor. Now for October, as I've shown you, October historically is a volatile month. It's the most volatile month of the year. It's funny because this follows the worst month of the year, which was supposed to be September. Talking about September, this is the 14th time since 1990 where the S&P 500 was up at least 10% through September. The S&P 500 went on to finish the year higher in 12 of the 13 prior instances. So again, the odds here are in our favor. Of course, it can be that this time we're going to be the odd one, and maybe we will finish the year lower. It can be. If we look here at the S&P 500, which has traded above its 50-day moving average for 108 consecutive days, no, actually a little bit longer. This was the 3rd longest streak going back to 1990. 95 and 2007 were longer. So again, you could say, oh, look, you see the dates? Aha, maybe history might not repeat itself, but it often rhymes. Now, one of the last couple of things I want to show you is this post here by Maverick Equity on X. Again, this is something that I've shown you before. For everyone that's comparing 2000 to what's happening right now, here it shows us very, very clearly, right? 2000 price parabolic, not earnings, right? This line here is earnings, this is the price. So earnings did not follow the price. Nowadays, especially since ChatGPT came out, you can see price went up, but so did earnings. And so I keep saying the same thing again and again. When we're going to see the big difference, right, the big divergence here between the two, then I think we can start to talk about, okay, bubble popping and a huge disconnect. And by the way, if we look here at earnings, when the market dropped right in 2022, Yes, earnings dropped, but the prices went down way too much. So overreaction in 2022. I mean, the fact that you could have bought a Google or a Meta or whatnot at $90 or so, which for Meta was like 7x ago, was quite astonishing. And lastly, purely looking at valuation, or in this case, the pricing metrics, next 12 months PE, back in December 99, you can see that the median next 12 months PE was 41 times. And these are the companies that are mentioned here: Microsoft, Cisco, Intel, Lucent, IBM, Time Warner, AT&T, Oracle, and WorldCom. Some of you might not even know those companies, including myself. Some of them: WorldCom, no clue; Lucent, no clue. But if we compare what type of companies we're seeing today, it's night and day. First of all, we have trillion-dollar companies today that are generating hundreds of billions of dollars in profits. Second of all, median here is at 31 times. You might say, oh, but historically speaking, the Schiller PE and this and that, it's too high. It's too high. Again, we are not in the same period. You didn't have companies this big 25 years ago. You didn't have companies this profitable 25 years ago. You didn't have companies that in just 3 years went from 0 to almost 1 billion monthly active users. I'm talking here about OpenAI. It didn't happen. It wasn't possible. It was impossible. Today, if you are an entrepreneur, your startup, yes, your tech startup or AI startup, can go from 0 to 1 very, very quickly. Very, very quickly. You can scale from $0 to maybe $100 million in ARR extremely quickly. Something that companies 25 years ago were only dreaming of. Maybe it was in their investor presentations, right? That, oh, we're going to be generating a lot of money XYZ years into the future. Well, today, yes, you have certain companies that do exactly the same thing. Like I said, I do think that we have some bubbles in the market. But today, you have also a lot of companies that are making money and have the tech to show for it. 25 years ago, a lot of empty promises, or a lot of promises that only became true 5 years later. So yeah, there is a huge difference. And so dot-com bubble fears, don't get scared out of your positions because of scary titles and because, well, experts say that, well, we are in 1999 or we are in 2000 or 1998, whatever. First of all, you should also know that all of these talking heads, some experts, some very good investors as well, some legendary traders, right? All of them have their own portfolios. And all of them have positioned themselves or are positioning themselves accordingly, which means that whatever their exposure is, that's going to be their narrative. Just so we're clear. So there is always going to be a bias. Lastly, at the time of recording this, you can see that the market is taking a little breather. We started the day very much green. Right now we do have some reds. If we look at the watch list that we have, we started the day again with only 3 red names. Now it's more like a 50-50 split right here. Rubrik is down almost 5%. That's good because I do want to add more shares there. Nebius, CoreWeave, all down 4 to 5% or so. As for the rest, also down a little bit. The names that are still up, SoFi is up 4.5%, was up 8% at one point. Oscar is up 4% on the reports or rumors that President Trump might actually extend the ACA subsidies in order to make sure that this government shutdown is over. Again, those are rumors and reports, and that's pure upside for Oscar because the guidance currently does not include any extension of the subsidies. AMD is up another 4% after effect of yesterday's announcement. Lots of price target raised as well. HIMS is up a little bit. PayPal is up 3%, was up 5% at one point, and I know some people are shocked that PayPal can go up. I agree, it's quite shocking. But for PayPal specifically, there is some news. Because PayPal announced that they're unleashing the power of retail media for small businesses, enabling them to join billion-dollar advertising boom. PayPal Ads Manager gives tens of millions of small businesses access to high-margin ad revenue while creating valuable new inventory for advertisers of all sizes. PayPal today unveiled PayPal's Ads Manager, allowing the tens of millions of small businesses that use PayPal to become their own retail media networks and generate new revenue streams. With 99.9% of all businesses in the US being small businesses, PayPal Ad Manager will help small businesses create billions of new advertising impressions for brands of all sizes by utilizing a fast-growing and highly profitable segment of digital advertising. We've talked, of course, about the PayPal Ads business for a while, but we didn't really get that much information from the company. So this is a pretty good start, and this should start and launch early 2026. I do believe that the ads business is going to bring in billions of dollars in revenue in the future. And of course, those are high margin dollars. And so overall, that's about it. Volatility is expected. Pullbacks happen all the time. Some people are traders, some people are long-term investors, completely different strategies, and that's completely fine. Up to you. You know my strategy. It's just raising cash. Taking profits is always fine as well. You raise cash, so if you have a crash, that actually rhymes, you can take advantage of those opportunities. Plain and simple. I think that I don't own a lot of super overvalued or overextended names. Again, if I compare my portfolio today to what it was back in 2021, 2022, it's night and day. The valuations back then, I agree, because I got hit like no other, so I don't want it to happen again. But I can see the huge difference, right? A Google, for example, is not expensive today, even with the rise in stock price. PayPal is not expensive today. Alibaba is not expensive. You might say that SoFi is expensive. I don't think it is. We're far away from the 50, 100 times sales that we've seen back in 2022. And when I will start to actually see this type of behavior with the companies that we do follow and maybe do own, then of course I will call it out. I will actually ring the ding, ding, ding. I will ring the bells and say, actually, guys, maybe it's time to take a lot of profits and be a bit more defensive. But that time has not come just yet. Unless you own quantum stocks, then yeah, sell and run away. That would be my preferable choice right here. So all in all, that's about it for me in this video. If you enjoy this type of videos, hit all the buttons, share your thoughts down in the comment section below, and we'll see each other in the next one. Bye-bye.